Qualcomm. Wow. From a high-flying $230, its stock price has, well, plummeted. It's down around $147 now.
Yeah, that's a pretty steep drop, about 36%.
Exactly. So the big question is this the moment you've been waiting for? You know, a chance to grab a tech giant on the cheap.
Or is it maybe a warning sign? Like, is there something deeper going on that could lead to a bigger fall?
That's what we're aiming to unpack today. Let's dive in.
Right. We're taking a deep dive into Qualcomm, looking at where things stand as of April 25th, 2025. They're this huge global player in wireless tech.
Chips and licensing, mostly.
Primarily, yeah, chips and their essential patents.
Yeah.
And with that price drop, it definitely deserves a closer look.
So we're going to use value investing principles, kind of dissect the info and see what really stands out for you, the listener.
Precisely. We want to figure out what truly matters here.
Okay, let's get started. Chapter 1, understanding the business. What's the core of what Qualcomm actually does?
Okay, so fundamentally, Qualcomm is what's called fabless. They design the chips, all the complex stuff.
The brains, basically.
Exactly, the brains. But they don't actually make them. They outsource the manufacturing, mostly over in Asia.
Like an architect designing, but someone else builds it.
That's a good analogy. And their money comes mainly from two places. First, QCT. That's Qualcomm CDMA Technologies. That's selling the actual chips.
Snapdragon processors, right, for phones and stuff.
Yes. Snapdragon is the big one for mobile. But they're also pushing hard into automotive and the Internet of Things, IoT.
Okay, and the second source?
That's QTL, Qualcomm Technology Licensing. This is where they license out their huge portfolio of patents. Think essential wireless standards.
Ah, and that's usually pretty profitable, the licensing part.
Oh yeah, very high margins, a real
Yeah.
cash cow for them. They also have a smaller arm, QSI, that makes strategic investments.
Chips and patents.
Yeah.
Sounds like a strong foundation. What are the key products and tech areas they're focused on right now?
Well, Snapdragon is still central, especially for mobile. They're also leaders in 5G modems and the RF front end.
The what now?
Yeah.
RF.
RF front end. It's the crucial bit that actually handles the radio signals, kind of the unsung hero of your phone's connectivity.
Got it.
But the really interesting thing is how they're trying to diversify beyond smartphones, because that market is pretty mature now.
Right, need new growth areas, like automotive.
Exactly. Automotive is a huge push. We're talking connectivity in cars, digital cockpits, driver assistance systems, AD, and even fully autonomous driving, AD.
I heard something about a big pipeline there.
Yeah, they've mentioned a $30 billion design win pipeline in automotive. So massive potential.
Wow. And other areas.
IoT is another big one, connecting all sorts of devices. And AI, specifically on-device AI.
On device. So the AI processing happens right there on your phone or car, not in the cloud.
Precisely. Faster, more private. It's a big trend. And to boost all this, they've been buying companies.
Ah, the acquisitions, like Nuvia.
Right, Nuvia for CPUs, River for ADS tech, parts of VinAI for AI expertise, Edge Impulse for IoT, and Edge AI.
So real strategy to branch out.
Definitely. But it's important to remember these new markets, auto, IoT, they have totally different competitors and challenges than the phone market.
Good point. Different battlegrounds. So where do they stand now? Market position, scale.
In mobile chips, especially for premium Android phones, they're still the leader. The king of the hill, really.
And company size.
Pretty massive. Around 49,000 employees globally, and trailing 12-month revenue was about $40.7 billion.
Serious scale. And they must spend a lot on R&D.
Oh, absolutely. Huge R&D investment. You have to in this business to stay ahead.
So boiling it down, what's the core value they offer? Why do companies use their stuff?
It's the cutting-edge tech. They provide the essential bits for connectivity, processing power, and now AI. For the device makers, the OEMs.
Like Samsung or Google?
Yeah, for them, using Qualcomm chips simplifies things hugely. Faster time to market. And for the whole tech world, their patents are basically essential for wireless standards to even work.
Okay, makes sense. Let's shift gears. Chapter 2, management. Who's running the show?
The CEO is Cristiano Amon. He's really been the one pushing this diversification strategy and overseeing those acquisitions we mentioned.
And the finance side.
That's interesting. Akash Pakuwala holds both the CFO and COO roles, Chief Financial Officer and Chief Operating Officer.
Both. That sounds like a lot for one person.
It is quite concentrated, yeah.
Yeah.
Worth noting. And remember, they also had that failed attempt to buy NXP a while back.
Right, that didn't pan out. So how are they managing the company's money? Capital allocation.
It seems like a balancing act. A big chunk goes into R&D, naturally. Then there's the M&A spending for growth.
And shareholder returns, buybacks, dividends.
Yes, they have a history of share buybacks, and they've been consistent with dividends, even increased it in March 2025. The forward yield is currently around 2.4 or 2.5%.
And the payout ratio, is it sustainable?
Seems reasonable, about 36% of earnings, so yes, looks sustainable for now.
Okay, and are they getting good returns on the money they're investing back into the business? Return on invested capital?
The numbers look pretty strong, actually. Trailing 12-month return on equity, ROE, is really high, like 42%.
Wow, 42%.
Yeah. Return on assets, ROA, is solid too, reported somewhere between 12.6% and 19.5%. And their return on capital for Q1 fiscal 25 was over 21%.
So they're generating good profits from their capital, suggests a strong business model, maybe a moat.
It definitely points that way,
Right.
likely from their intellectual property and maybe network effects in mobile. But the big question is whether that moat is strong enough against, geopolitical risks and more competition in these new areas they're entering.
Right. So overall assessment of management. Capable, but maybe some flags.
Generally capable, yes. But the heavy reliance on M&A for diversification carries risk. Integrating acquisitions isn't easy.
And the NXP failure is a reminder.
Exactly. Plus, that concentration of CFO, COO roles in one person, Pelliquala, that's a potential key person risk. What happens if he leaves?
Hadn't thought of that. What about governance scores?
Their overall ISS score is okay, a 2. But the scores specifically for shareholder rights and compensation are weaker. Both are 5s. That might raise some eyebrows for shareholders.
Okay, interesting. Let's pivot to the financials themselves. Chapter 3, Financial Health. Give us the key numbers.
All right. As of our analysis date, April 25th, 2025, market cap around $162.8 billion. Share price hovering near $147.
And the valuation metrics, PE ratio.
Trailing PE was in the 15-16 range. Forward PE looking ahead is lower, around 12.
For earnings per share.
Trailing 12 months, between $9.27 and $9.47. Revenue for the same period was about $40.7 billion.
And that revenue was growing.
Yep. Decent year-over-year growth, over 12%. Profit margins look good, too. Gross margin around 56%.
That's strong net margin.
Also robust in the 26-27% range. Very profitable.
Okay, what about debt? Are they loaded up or?
Their debt-to-equity ratio is pretty moderate, about 0.54. Total debt is roughly $14.6 billion.
Which sounds like a lot, but how much cash do they have?
That's the key. They have almost the same amount in cash, around $14.3 billion. So their net debt position is close to zero. Very flexible balance sheet.
Nice. And free cash flow, are they actually generating cash?
Definitely. Trailing 12-month free cash flow was impressive, about $9.7 billion.
And we mentioned the dividend yield, 2.4, 2.5%. What about price to book?
It's a bit higher, in the 5.7 to 6.1 range. Reflects that high ROE probably.
So summing up the financial health, looks pretty solid.
Yeah, overall it appears quite strong. Good profitability, strong free cash flow generation, and importantly, that free cash flow is close to their reported net income.
Suggesting high-quality earnings.
Exactly. Not just accounting profits, but real cash coming in.
Yeah.
That gives them a lot of flexibility for investment, M&A, dividends, buybacks, whatever they choose.
All right, solid foundation financially. Let's move into the second half now. Chapter 4, Market Sentiment. How is the market feeling about Qualcomm right now? Mixed.
Very much mixed, I'd say. There are definitely ongoing worries, the cyclical nature of semis, intense competition.
And the big customers trying to design their own chips, like Apple.
That's a big one, yeah. Vertical integration threats. And then there's the whole U.S.-China trade tension thing. Tariffs are a constant background worry.
That probably explains some of the stock price drop.
Likely a factor, yes. But on the flip side, there's real excitement about their potential in AI and automotive. And their last quarterly results, Q1, were actually quite strong.
So everyone's waiting for the next earnings report.
Absolutely. Q2 earnings are due April 30th. That'll be a key data point.
What about the professional analysts? What are their price targets suggesting?
Well, the average target is quite positive, somewhere around $191, $193. That implies a lot of upside from $147.
But averages can hide things.
Exactly. The range of targets is huge, from $140 on the low end to $250 on the high end. That tells you there's a ton of uncertainty out there.
So analysts aren't all on the same page.
Not at all. The consensus is generally outperform or buy, but there have been some recent downgrades too. As always, you take analyst targets with a grain of salt, right? They often focus short term.
Right. Any other recent news really moving the needle on sentiment?
It's mostly focused on those upcoming Q2 earnings. Any news on AI and auto progress, the dividend, M&A chatter like reports they cooled on buying Intel, and of course any headline about US-China trade or tariffs. That stuff always spooks the market.
What about short sellers? Are lots of people betting against the stock?
Actually, no. Short interest is relatively low, only about 1.5, 1.7% of the float,
And days to cover.
around 2 days. So it doesn't look like there's widespread, heavy bearish betting against Qualcomm right now. There's options activity, sure, but it's hard to read clear sentiment from that without digging deeper.
Okay, low short interest. Let's look at who does own the stock. Chapter 5, ownership structure. Who are the main holders?
It's overwhelmingly institutions, about 80% institutional ownership.
Wow, 80%. So big funds, investment firms.
Yeah, I think big names like State Street, Goldman Sachs, Vanguard, BlackRock, they hold large positions.
And what about insiders? Management, the board?
That's the stark contrast. Insider ownership is really low, like 0.1%. Very small direct stake held by the people running the company.
80% institutions, 0.1% insiders. That's quite a gap. Are insiders buying or selling their shares recently?
The trend has been net selling. More shares sold than bought by insiders recently. The net volume is around negative 6.13%.
Is that necessarily a bad sign? People sell for lots of reasons, right?
True, it could be for personal financial planning, diversification, whatever. But a consistent pattern of net selling can sometimes be seen by the market as a bit of a negative signal. Doesn't automatically mean trouble, but it's something to note.
So how does this ownership structure, high institutional, low insider, potentially impact things, governance?
Well, high institutional ownership can be good. These big firms have the clout to push for better governance and advocate for shareholder interests.
They can hold management accountable.
Potentially, yes. But the very low insider ownership does raise that classic alignment of interests question. Is management's main incentive truly aligned with long-term shareholders if their personal wealth isn't significantly tied up in the stock?
Connects back to those weaker ISS scores for shareholder rights and compensation you mentioned.
Exactly. It fits that picture. Ideally, from a value perspective, you often like to see management with significant skin in the game through direct ownership.
Okay, good context on ownership.
Oh.
Now let's really dig into the downsides. Chapter 6, risk assessment. Maybe frame it with a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sure. Strengths we've covered. Dominant in mobile chips, that valuable IP portfolio, strong profits and cash flow, tech leadership in 5G, AI.
Weaknesses.
Historically reliant on the cyclical smartphone market, dependent on a few large customers like Apple and Samsung. The fabless model means supplier dependency, low insider ownership, as we just discussed, and many challenges integrating all those recent acquisitions smoothly.
Opportunities seem clear, too. 5G rollout continues, big growth potential in automotive and IoT, rising demand for AI everywhere.
Right, and maybe even expanding into PCs or servers more aggressively.
Okay, now the big one, threats. What keeps Qualcomm management up at night?
Competition, definitely. Intense from rivals like MediaTek and potentially Intel or AMD in new areas. Then there's the threat of customers like Apple designing more of their own chips in-house.
The vertical integration risk?
Yes, and then the huge one, geopolitical risk, specifically U.S.-China tensions and potential tariffs. Add to that the normal semiconductor cycles, ongoing lawsuits like the one with ARM, and increasing regulatory scrutiny globally. It's a complex landscape.
Let's really zero in on that tariff risk. You mentioned potential hypothetical U.S. tariffs in 2025. How vulnerable is Qualcomm?
Very vulnerable, potentially. Remember, they're fabless, relying on Asian manufacturing, and a huge chunk of their revenue, like 46%, comes from China.
So tariffs would hit them hard.
How? Several ways. First, tariffs on imported chips increase their costs. Hard to pass that fully onto customers because competition is fierce. So gross margins get squeezed.
Makes sense.
Second, it could disrupt demand, especially if China retaliates. They might favor local Chinese suppliers, put up other barriers. Plus, tariffs make phones and devices more expensive, which could dampen consumer demand overall.
So lower margins and potentially lower revenue.
Exactly, which flows right down to lower net income, lower earnings per share, less free cash flow.
And the stock valuation.
Market would likely demand a lower multiple, reflecting the higher risk and lower growth prospects. And competitors less exposed to U.S.-China friction might gain an edge.
So this isn't just a minor issue. It's a major, unpredictable risk outside their control.
Precisely. And for value investors who prize predictability of earnings, that kind of geopolitical uncertainty is a huge red flag.
Okay, that paints a clear picture of the risks. Let's wrap things up then. Chapter 7, brief conclusion and the end hook reveal. What's the big takeaway here?
Well, it's really a story of two sides, isn't it? On one hand, you have Qualcomm's undeniable strengths, tech leadership, that valuable IP, strong profitability, really attractive fundamentals in many ways.
But
But it's overshadowed by this significant geopolitical vulnerability. The potential tariff impact, the heavy reliance on China, that's the major overriding risk right now.
which leads us right back to our initial question for you, the listener. Given all this, the strong business, the growth potential, but also these huge geopolitical clouds, is Qualcomm a true deep value opportunity right now?
Or is it maybe a value trap? Looking cheap, but with hidden dangers, potentially sprung by forces like tariffs, that could keep the stock down. Stick around, we'll give our final thoughts.
Welcome back. So our final take on Qualcomm. We've laid out the case, attractive financials, leadership in key tech areas, but as we've really hammered home.
That tariff risk and the China exposure, it just casts a long shadow.
Right. And for a value investor, that predictability of future earnings is just so crucial. This geopolitical stuff really muddies the waters, doesn't it? Makes prediction incredibly difficult as of April 2025.
Absolutely. And it makes you think bigger, too. Given Qualcomm's central role in connecting everything, if these geopolitical tensions keep rising, well, what does that mean for the entire tech supply chain?
Yeah, what are the ripple effects for your other tech investments? That's a really provocative thought for you to mull over.
So, our bottom line. While Qualcomm has strong fundamentals, that looming threat of tariffs and the deep China ties create a level of uncertainty.
That demands extreme caution, especially for a value-focused approach right now in April 2025.
That margin of safety, the bedrock of value investing, it just feels significantly eroded by this unquantifiable geopolitical risk.
Well said. If you found this deep dive helpful, definitely subscribe to the Stock Analytics AI YouTube channel. We do these kinds of in-depth analyses regularly.
Yep, and check the description below for links to the research we discussed today.
And just a reminder, this analysis reflects information available as of April 25th, 2025. We use public research and AI tools to synthesize data, but always do your own homework before making any investment decisions.